Huge news from Jerome Powell and the Fed today. But even bigger is what to do with this news and how to invest so that we can profit even more down the road. The Fed slashed interest rates by a half point, which is an aggressive start to its first easing campaign in 4 years. A lot of people thought it was going to be only 25 basis points, but this 50 basis points means a lot for your investing. This is just the beginning, but if we take advantage right now, we're going to be set up for success. This is time intensive though, because now that the rate cuts have begun, things will be moving quickly, so you need to make some moves. And for any of you invested in the Magnificent Seven stocks such as Nvidia, Apple, Microsoft, or Tesla, you definitely want to listen up. Federal Reserve interest rate cuts can have a huge impact on investors' portfolios. For example, some sectors and industries outperform in lower rate environments. According to research, cyclical sectors such as consumer discretionary and industrials tend to perform well when interest rates are lower. Lower rates reduce borrowing costs, benefiting capital-intensive industries. This would be companies like Nike, Starbucks, and McDonald's for consumer discretionary, and then companies like Waste Management, FedEx, and Lockheed Martin for industrials. Or you can mitigate the risk, and instead of investing in individual companies and hopefully picking the best one, you could actually invest in the entire sector with a sector ETF, like going with the SPDR Consumer Discretionary ETF XLY, which holds all these great companies like Amazon, Tesla, Home Depot, McDonald's, Starbucks, Nike, and Chipotle, or the SPDR Industrials ETF XLI, which holds the companies I spoke on before, and then GE Aerospace, Caterpillar, RTX, and Union Pacific rounding out the top 4. XLI over the past year is up over 23%, so don't sleep on that one, y'all. My name's Nolan Gouveia, my students call me Professor G, and I made this channel to make investing simplified. Now, if Fed rate cuts occur as they're supposed to over the next couple months in 2024, it's important to understand how they could affect your investments. Though this first cut was a good one and a solid one at 50 basis points, as you can see here, we have a lot of room to make up, to take away from what was added in 2022 and 2023. This September cut, along with the possibility of at least one more this year, should be welcome news to investors. Economists are also forecasting that Wednesday's rate cut will mark the first in a series of reductions this year and into 2025, with many analysts expecting the Fed to also cut its benchmark rate at its November and December meetings. A reduction in the federal funds rate, commonly referred to as a Fed rate cut, is usually intended to support growth or manage inflation. It can also be done to stabilize financial markets. That was the case when the Fed cut rates after the September 11, 2001 terror attacks. Since we have been seeing more positive inflation numbers, and since we're seeing not so positive unemployment and joblessness numbers, it was definitely time for a rate cut. And this was just the first of many. The most important thing to understand is what's actually going to happen in the stock market because of this. And there's two very important things that you're going to want to know. One that most people are totally overlooking. Lower interest rates can make certain sectors and industries more attractive as their borrowing costs are reduced. That, in turn, may boost profitability. When earnings rise or are expected to rise, investors often sell bond holdings and put the sale proceeds into equities. The two things that were stated here and that are gonna happen in the environment that's just about to begin is, number one, the stock market should rise over time. The whole point of bringing down rates is to make money borrowing cheaper for both individuals and companies. And so when a company can borrow money for cheaper, that improves their bottom line and can increase their hiring so more people have jobs and make more money and spend more money at other companies, which increases profit all over, which makes the stock market go up. The second thing stated here is the thing that I think is more important, and it's the thing that I've been trying to say for the past year now. Number two is that currently there's so much cash and money just sitting off to the sidelines. With rates up as high as they've been, it just makes so much sense for wise and wealthy investors to just park their money somewhere where they're gonna get a guaranteed 4 to 6%. They don't have to worry about their money dropping during this volatile time, and they're totally happy earning that 5% or whatever from things like money markets, bonds, and high-yield savings accounts. People wonder why Warren Buffett has around $200 billion sitting in these types of accounts right now. There isn't much downside with rates as high as they've been, and so he's just parking his money there as he waits for the market to drop a little bit so that he can buy in at more favorable prices. Right now, the rates are being cut, but lightly. The economy is still hurting right now and will be hurting for the next 6 months, possibly even a year. That's the whole reason why they have to make these cuts. That means the economy is not doing as good as it could, which means that we could see a little bit of a drop in the market overall, especially in the short term. After the election, we're probably going to get some new information and some actual real numbers of what it's actually been doing over the last year or so. They're not going to put out any bad information during this election time. They're going to give us kind of like a surprise a month or two later down the road, because eventually they do have to disclose the information so that we can actually do something about it. So initially, especially maybe at the end of this year, but for sure at the beginning of next year in 2025, I can see the stock market dropping a bit, but long term, I 100% believe that the entire stock market will be booming and just go right back up and eventually surpass any all-time highs. Right now is the most important time to be investing. As the rates get cut more drastically as time goes on, all this money that's sitting in things like bonds or money markets or high-yield savings accounts is not going to be as favorable for people to be holding their money there. Instead of them getting this guaranteed 5 or 6%, it's going to be down to like 1 to 2%. That's definitely not as fun and definitely not as advantageous for their money. So these people are going to be moving their trillions of dollars into the stock market and into equities. That alone is going to increase the stock market because of all the money flowing in. We as investors want to be invested before that happens, not after. While a rate cut would likely benefit tech stocks, it would also boost other sectors and industries. That means market breadth. The ratio of rising stocks to falling stocks could improve, which would be a sign of wider strength that's not concentrated in just a few stocks. Obviously, over the last year or two, it's been a no-brainer to invest into these 7 Magnificent 7 stocks. Almost every week, they're hitting new all-time highs and they're absolutely crushing almost everything in their path. They're actually some of the only stocks that have been holding up the entire S&P 500. So during that time and over the last year, I've been getting many questions asking, if these are the best stocks and these are the only ones doing really, really well, why not just invest in the Magnificent 7 rather than investing in the S&P 500? Well, this coming time that we're about to jump into might start to see a flip in that. Assuming the Fed continues to cut rates, it will likely be the start of a multi-quarter rate-cutting cycle, which could drive investor interest away from the Magnificent 7 toward the rest of the market, which has been quietly languishing in a bear market since the 2021 peak. This is why I've been so adamant that people stick to the 3-fund portfolio and specifically stick to the one piece of that portfolio that's been the most lackluster, the most boring, the one that most people are actually starting to shy away from, and just stick to the more fun pieces. The foundational section, which would be the S&P 500 or the total US stock market, has been booming. The growth section, like QQQM or SCHG or VGT, has been absolutely slaying, but SCHD has been the one that has been pretty lackluster and one that a lot of people have given up on. I've received messages from people saying something like, I don't know, I don't believe in SCHD as much as you do, Professor G. Well, this is the genius of the 3-fund portfolio. There will be times when dividend/value is not as exciting and when growth is going to be going through the roof. But then there's going to be times where that flips and growth drops, and at that point, that's when value or dividend is going to be the smart move. We know this because we can look back and see that over these last couple of years, growth has been going crazy, and SCHD or value type funds have been holding their own, they just haven't been as fun. They haven't been growing by as much. But now with all this data showing that with rate cuts comes a bit of a slowdown in tech focus, as more investors look to find deals throughout the entire market, SCHD and value style funds enter the chat. Not only that, but think about the type of money that is sitting off on the sidelines. Those trillions of dollars are sitting there from people who don't want to risk their money in something crazy like growth funds. They don't want it to be in something super volatile, and that's why they don't have it in growth funds right now, even seeing all the growth that's happening. They'd rather park their money somewhere safe, giving them a guaranteed risk-free amount, even if it is much, much lower than what they could be doing. They just don't want to risk it in that way. If these risk-averse people do need to move their money because they know that it's not smart to just hold all of their money in something that's only getting them 1 or 2%, that's only keeping up with inflation and probably actually lower than inflation. So they have to at least put it into something. They're gonna pick something that's very, very low volatility, as safe as possible or as safe as you can get within equities, and that's gonna be the value style of investing, or SCHD. They also really like the idea of getting that dividend every quarter because they're used to getting that cash flow from either bonds or high yield savings accounts, and they like the interest payment or the dividend payment that it brings. I can see SCHD rising sharply in the next 3 years, and I wouldn't be surprised if it hits over $100 a share and never looks back. I'm definitely investing in all 3 sections of the 3-fund portfolio, but for sure investing heavily in SCHD. To learn more about SCHD specifically, watch this video here, or watch this video on the most simple 3-fund portfolio out there that's incredibly effective, and it's crushing it by all standards.